Hi, and thanks for watching episode 8 of our trading series. My name is Vincent and I work at Maven. Today I would like to start discussing options. Options are an example of derivatives, like we've seen in the trading the futures last episode. As you can see, there are many sessions on options, so this is just the beginning. So let me first explain you what an option actually is. An option is very similar to the future or forward contract we have seen before. It's just a contract, an agreement. However, there are minor differences. First of all, someone who owns an option, that contract, that person bought it from somebody else. So there's again an agreement between a buyer, an option buyer, and an option seller or an option writer. The one who actually possesses the option has the right to do something, whereas the future agreement was an obligation. If you agree on the future price of something, you might remember from the previous episode, that has to become fulfilled at the very end. In this case, if you decide to buy an option from somebody else, you have the right. So it's a bit more lighter. You have the right to what? You have the right to buy or sell. So there are two types of options. There's a call option, which gives you the right to buy, but there's also a put option, that's a different class of options, that gives you the right to sell. Well, but let's stick for the call. Throughout most presentations I stick to the call because the put option is kind of a similar story. So in case of a call, if you own a call option, you have the right to buy an amount of underlying items, and typically these are stocks. So you have the right to buy a particular amount of stocks for a certain strike price at or before a certain date. So these are kind of contract specifications of the option contract. So this requires an example, I believe. So let's take this as an example. Let's say we have a company, Siemens, which is a German manufacturer. And let's say these stocks are traded in the market at 95 euros a piece. Also, imagine today is the 1st of July. And let's now consider the Siemens December 100 strike. This 100 refers to the strike price I discussed before, call option. And in short, we will typically use abbreviation the Siemens DEC 100 call. In fact, it's just like literally a contract. That's why I put a picture like this. The Siemens DEC 100 call. If you are the owner of this particular contract, it gives you the right to buy Siemens shares. And typically the contract specifies how many Siemens shares you can buy with this one single contract, and typically this is 100 shares. We would call it a multiplier. So this contract gives you the right to buy some Siemens shares at or before a certain date in the future, which is December, and it could be some sort of, let's say pick the 16th of December, for a certain strike price, which is 100 euros. And this is an important number. So this contract gives you the right to buy a stock, this particular stock, at 100 euros. Which now sounds not that very wise to do, because you can buy the stock at 95. Why would you make use of your right to buy it for 100? But we will see that later. All right, let's fast forward now. It's now 1st of July, but let's fast forward to December. What is the value of your contract? Well, you might understand this picture. If the stock stays at 95, your contract is worthless. You are not going to make use of your right to buy the stock at 100 euros, while actually the stock is trading at 95. You're not going to do that. Likewise for lower prices. So you can see your option is only going to be worth something if the final stock price in December is exceeding 100. Then only it becomes interesting, right? So for example, let's say in December the stock will trade 105. Then the value of your contract is, yeah, you have the right to buy the stock at 100. So that will give you a 105. That will give you a €5 profit. Okay, now you also have to know this is a contract swap. So you bought the option from somebody else, so there's also a somebody else. And what is the payoff, as we would call this, from the other person? Well, it's kind of the flip image of this. It should be a zero-sum game. So this would be the picture of the other person, which is a bit weird, because you can see, for this person, she can only lose. Right, so if the stock stays below 95, she makes nothing, and if it moves above 100, she has to pay you the money. So why would you be on the other side of the transaction? So there's a small caveat here. You, this is our picture, right? We paid money up front to the other person to get this kind of payoff structure, and she received money to get into this structure. So we have to take those initial costs into consideration to draw a profit and loss diagram. So this is what it should actually look like. So initial costs were involved. So in our example, let's say I bought this option from somebody else for a price of €2. Then this is what the actual profit and loss diagram will look like, right? This means that if the stock stays where it is, 95 in our example, the option contract is worthless, but I lost my €2 I paid upfront, right? So this is the actual payoff diagram or the P&L diagram, I have to say. And the break-even point isn't really 100, it's really 102, as you can see here. And now you can see that it also actually makes sense to be on the other side of the trade. This is the payoff diagram from the other person. And she makes money as long as the stock stays below 100. Actually, it stays below 102. And only when it exceeds 102, she starts losing money. So now you can see why it can sometimes be profitable to be on that side of the trade as well. All right, so from a put perspective, there are 4 versions basically. So we've seen this. If you buy a call option, it looks like this. If you're on the other side of the call option, it looks like this. So these two we have seen. Now the put option gives you the right to sell. So if you consider a little bit, this would be 2 particular graphs of a particular put option. Just to complete the picture a little bit. So there are 4 possible building blocks if you want to use options for buying a call, selling a call, buying a put option and selling a put option. And what is now very interesting is we can use and combine these building blocks to create option structures. This is a very interesting one, for example. Let's say you buy the 100 call as before for $2 or €2. And also you would buy the 95 put option for $4. So the dashed lines are the individual legs. So you can see here our familiar call option, the 100 call option, paid for €2 or $2. And the 95 put as well, which looks like this. This one will only start making money if the stock falls below 95. And then there's a break-even point here. That break-even point is 91. Why 91? Because you paid 4 for it here. So the dashed lines are the 2 individual legs. And if you add both graphs, you get kind of the orange-yellow line. This is the total payoff diagram of the 2 options combined. So now you can kind of see a nice shape, and you can see from the yellow line where you make money and where the break-even points are. So you could argue, like, as long as the stock stays between 88 and this other point, 105, I think, maybe not, you kind of are still in the minus, but you start making money if the stock exceeds this break-even point, or if the stock falls below this break-even point. This could be an interesting payoff diagram for you as an investor if you really want this. We call this the strangle, by the way. If you buy a call and you buy a put as well, at a different strike price, we call it a strangle. I have another example. Let's say you buy the 95 call. It's this dashed line, right? So you buy this call, it goes all the way up there. And simultaneously, you sell the 105 call for 1. Okay, selling a call was kind of this structure, so you get money up front. That's why the line starts higher than the x-axis. And kind of only if it falls higher than 105, comes higher than 105, actually 106, then you start losing money. So these are 2 trades you can simultaneously do. And the combined graph actually forms, we would call it a call spread. Actually, you see, as long as the stock stays below this point, you lose this investment. It looks actually like an ordinary call, but once it exceeds this number, actually the profit is kind of flat again. So why would you prefer this yellow structure over just buying the 95 call? If you just buy the 95 call, you have to invest 4. But if you invest this yellow structure, you have to invest only 3. Yes, your upside is kind of capped, but this could be one of your assumptions anyway. Okay, so in summary, options are contracts that give you the right to exercise before a certain date. Combining option positions can create nice payoff structures, like the call spread we've seen and the strangle we've seen. And many investors, they buy and sell options and combine them just from a payoff diagram perspective. So they kind of buy the call spread, for example. They just know this is going to be my payoff diagram in December. They sit on it and kind of see and wait or anticipate if they make a profit or not. Not everyone will play this particular game, as we will see in subsequent series. But good to recall, many investors just solely base their option investments based on the payoff diagrams. Thanks for watching and stay tuned for more episodes.